Imagine police drones buzzing over quiet neighborhoods, hunting secret Bitcoin miners, while across the ocean, one man's speech sends crypto prices on a roller coaster. Sounds like two unrelated thrillers, right? Well, this is happening right now. Thousands of illegal Bitcoin mining operations in Malaysia have stolen over $1 billion worth of electricity. And at the same time, the US Federal Reserve's interest rate moves are whipsawing the crypto market. How on earth are these two dramas connected? Let me take you on a journey where I find out and end up seeing the crypto world in a whole new light. An official inspects confiscated Bitcoin mining rigs after a raid in Malaysia. I recently stumbled upon a Bloomberg report that blew my mind. In the past 5 years, Malaysian authorities have cracked down on around 14,000 illegal crypto mining sites that siphoned off over $1.1 billion in electricity. Yes, billion with a B. These aren't just a few folks gaming their electric bill, it's a massive, organized power theft. And stopping it has become a cat and mouse game worthy of a cyberpunk novel. Enforcement teams are using drones with thermal cameras to scan for the telltale heat of mining rigs, and handheld sensors to sniff out irregular power usage. In one case, residents reported strange chirping noises at night. Turns out illegal miners were blasting fake bird sounds to mask the roar of their machines. Imagine living next door to what you think is an exotic aviary, only to find it's a secret Bitcoin farm. The scale of this operation is astonishing and a bit terrifying. Malaysia's main energy company, Tenaga Nasional, has lost so much revenue that officials warn the power grid itself is at risk from the strain and tampering. In fact, things have gotten so serious that in late 2025, the government set up a special committee to consider a complete ban on crypto mining. Even legitimate tax-paying mines might get the boot. The Deputy Energy Minister, Akmal Nasir, said the threat isn't just theft. These rogue operations could break our facilities and are becoming a challenge to our system. When I read that, I pictured a swarm of underground mining rings almost waging war on the nation's infrastructure. What really struck me is how organized these illegal miners are. We're not talking about a geek with a rig in his garage. According to officials, it's syndicates, outright criminal gangs behind this. They move from one empty warehouse or abandoned shop lot to another, constantly on the run. They'll even rig up insulation to hide heat, put up CCTV cameras and booby traps like broken glass on walls to keep authorities out. It's like something out of Narcos, but with crypto mining rigs. And guess what's been fueling this frenzy? Bitcoin's price surge. In October 2025, Bitcoin hit an all-time high around $126,000. Even though it's come down since, those high prices made mining super profitable, if you don't pay for electricity. Thousands of people decided it was worth the risk to steal power and mint digital gold. Malaysia isn't alone here. In Iran, illegal mining has been blamed for rolling blackouts, and Kuwait had to crack down amid a major power crisis. It's a global whack-a-mole game. Meanwhile, the United States has become the legal mining capital of the world, now hosting an estimated 75% of Bitcoin's mining activity after China's exit, and consuming more electricity than some entire countries for it. At least in the US, they pay for their megawatts, I hope. Sitting at my desk reading about drones hunting miners and bird call camouflage, I had to laugh at the absurdity. And then the gravity hit me. This was a glimpse of crypto's gritty reality. Behind those shiny Bitcoin numbers on my screen is a very physical battle over resources. I found it equal parts fascinating and sobering. As a crypto enthusiast, I love the idea of decentralized networks, but here was a reminder that decentralized doesn't mean disconnected from reality. Crypto runs on electricity, and people will go to extreme lengths, even crime, to get a piece of the action. This illegal mining saga also got me thinking about the lengths people go to earn crypto. and whether there are better ways. Full disclosure. Around the same time, I started experimenting with something called Unity nodes, a totally legal and far more low-key way to participate in the crypto network. Unity nodes are described as software licenses, not NFTs in the collectible sense. Basically, they let you turn everyday devices, like smartphones, into part of a global, decentralized network that provides telecom services, and you earn crypto rewards for it. No massive rigs, no secret warehouses required. The idea sounded crazy enough to try. I got a Unity node license, which isn't cheap, by the way, about $5,000 for the license, a fact I learned the hard way. It comes with the ability to connect up to 200 devices, but I started small with a 10-device setup using some old Android phones I had lying around. I installed the Unity app on each phone, essentially enrolling them as operator nodes. Now, these phones aren't mining Bitcoin or anything. Instead, they perform useful work for a telecom network, things like verifying calls or detecting network issues. Imagine a decentralized cell network powered by the blockchain by users. It's like I've deployed a mini digital workforce. Here's the fun part. The payouts come in crypto, and not some obscure token, but actually in mainstream coins like Bitcoin, Ethereum, Cardano, even XRP. The dashboard lets me withdraw rewards in my choice of these coins, which is awesome. Seeing a few sats, small fractions of BTC, roll in because my old phones are working felt like magic at first. Of course, let me manage expectations. I'm not getting rich off this. 10 phones running for a few weeks have earned me only modest rewards, nowhere near the $5,000 cost yet. This is a long-term play to see if it can eventually pay for itself. But it's been fascinating to test a passive income idea that doesn't require a giant mining farm or, stealing electricity. My phones sip power on my own bill and stay pretty cool, as opposed to those roaring ASIC miners. Crucially, Unity nodes emphasize that these are software licenses, not NFTs, in how you use them, even though under the hood they do use NFT tech for ownership records. The distinction is basically marketing, but I get why. They want people to see it as buying a functional license, not speculating on a digital collectible. In practice, I own a Unity node license that I could even transfer or lease out, according to the docs. But for me, it's about the experiment. Can regular folks participate in the growth of networks like this and earn something without needing to be part of a shady operation? So far, it's been a geeky little adventure. I check my app and see a few ADA or XRP trickling in here and there, and it puts a smile on my face. It's like the anti-mining. Instead of guzzling power in secret, I'm contributing a bit of connectivity in the open. The contrast isn't lost on me. As I was reading about those raids in Malaysia, I was also looking at my neat row of phones thinking, this is a much calmer way to earn crypto. No cops, no drones, no fake bird sounds needed. Light humor aside, this experiment showed me that the crypto ecosystem is evolving new models for participation. Not everything has to be about high-powered mining or yield farming. Some ideas are as simple and as hard as connecting real-world utility with crypto rewards. It's early, and who knows if Unity nodes will succeed. But I love that I'm learning through doing, not just hodling and hoping. Just when I thought I had seen the extremes of crypto's underbelly and innovation, another storyline was unfolding in parallel, not in some hidden mining den, but in the marble halls of the US Federal Reserve. It's a world away from Malaysian miners, yet it's impacting our crypto investments just as much. In fact, I've come to realize that Jerome Powell's decisions at the Fed can sway my portfolio more than any crypto white paper or Twitter hype. 2025 drove this lesson home for me. Here's what happened. In December 2025, the Fed cut interest rates by 0.25% for the third meeting in a row. bringing the benchmark rate down to about 3.5% to 3.75%. That's the lowest rates have been in 3 years. Now, typically when the Fed eases up like that, it's good news for markets. Cheaper borrowing, more liquidity, it's like giving the economy an energy drink. And indeed, the crypto market initially reacted like a kid on Red Bull. Bitcoin's price immediately spiked, briefly shooting above $93,000 on the news. I remember watching the chart that day. It was as if traders had this Pavlovian response. Fed cuts rates, buy Bitcoin. But here's the twist. That excitement was really short-lived. By the next day, Bitcoin had actually slipped back down under $90,000, and many smaller altcoins were deep in the red. No Santa Claus rally, no sustained euphoria, just a blip. So, what happened? In 2 words, Jerome Powell. Right after the rate cut, Powell gave a press conference and basically poured a bit of cold water on the party. He indicated that it's going to be hard to justify further rate cuts for now, and that Fed officials only predict maybe one more small cut in 2026. In fact, some on his team thought even this December cut was borderline and voted against it. That hawkish tone, even as they were cutting rates, made investors hit the brakes. It's like the Fed gave us dessert but scolded us not to expect another serving. From my perspective, this was a fascinating pattern. Markets are forward-looking and emotion-driven. They weren't reacting just to the cut, but to Powell's comments and vibes. Stocks actually went up initially as Powell spoke, since the cut was expected. But crypto traders are a jittery bunch and seem to have focused on the uncertainties he highlighted. Powell essentially said, "We're easing a bit now, but don't bet on a series of cuts." And since everyone knows he's fighting stubborn inflation, still above the 2% target, that caution scared the easy money crowd off a bit. One analyst put it well, markets are allergic to uncertainty, and right now, heading into 2026, there's a lot of uncertainty. Let's put it in context. A couple of years ago, in 2022, the Fed was hiking rates aggressively to fight that post-pandemic inflation, and it absolutely clobbered crypto prices. That was the start of a harsh crypto winter. Now in 2025, we're seeing the opposite. Rate cuts. But because they're cautious and possibly ending soon, crypto hasn't exploded upward like some hoped. In fact, despite 2025 containing some big positive events, like multiple Bitcoin spot ETF filings, etc., Bitcoin is ending the year only around the $90,000 range, not the $200,000 some bulls predicted. Standard Chartered had once forecasted $100,000 plus by end of year, even $200,000 in extreme cases. But they had to slash those targets as reality set in. One fun, or not so fun, stat. Bettors on Polymarket are giving an 81% chance that Bitcoin will drop to $80,000 before it ever reaches $150,000 next. In other words, caution is in the air. A big reason for that caution is exactly what I'm talking about. The Fed and macroeconomics now dominate the crypto narrative. One crypto analyst said that almost all the internal crypto hype cycles, like halvings, new tech upgrades, are either priced in or have slow effects, and at this point, macro conditions drive Bitcoin's performance. I've really internalized that. We crypto folks love to think BTC is an uncorrelated asset doing its own thing, but in truth, Bitcoin has been trading like a high-octane tech stock. When liquidity is cheap and abundant, it soars. When money is tight, it struggles. Now, looking ahead to early 2026, there's an additional plot twist. Jerome Powell might not be steering the ship much longer. His term as Fed chair ends around February 2026. And curveball, the US just had an election where Donald Trump returned to office, his second term. That means Trump gets to pick the next Fed chair. This is huge because it could drastically change the Fed's approach. The rumor mill says all 5 candidates on Trump's shortlist are actually pro-Bitcoin in some form. That's something I never expected to read in a finance article. But more importantly, they're likely to be a lot more dovish, meaning they favor bigger rate cuts to boost the economy. One name floated is Kevin Hassett, a former economic advisor. He's openly said there's plenty of room to cut rates much further if conditions allow. On paper, that sounds bullish for crypto. A Fed chair who's okay with slashing rates and doesn't hate Bitcoin? Sign me up for the moon, right? But here's the catch. If the Fed suddenly becomes too politically driven, like cutting rates hard because the president wants it, it could spook investors across the board. The Fed's credibility might take a hit if people believe it's no longer acting independently to keep inflation in check. Ironically, a super pro-crypto Fed chair might hurt crypto in the short term if it triggers, say, a loss of confidence in the dollar or bonds, or if inflation perks up and causes panic. It's a weird, delicate balance. Personally, I'll be watching those first few Fed meetings of 2026 like a hawk. Powell will still be there for at least the first quarter. He'll oversee about 3 interest rate decisions into 2026. If he holds rates steady or only does one mild cut and then a new chair comes in mid-year, we could see some whipsaw in markets as everyone recalibrates to the new regime. Will they cut more aggressively? Will that ignite a new crypto rally, or will it coincide with some economic downturn that hurts crypto? These are big unknowns. But one thing's for sure, the days of ignoring the Fed are over for crypto investors. I joke that I've started reading Fed meeting transcripts more carefully than some crypto white papers. Powell's dry, measured statements have become as important as Vitalik's tweets in gauging where things might go. All these big-picture events, criminal mining operations, central bank maneuvers, it's enough to make one's head spin. And it got me thinking about something much closer to home, my own crypto safety net. It's great to understand global forces, but what about the basics of how I buy, sell, and hold my crypto? Am I prepared for the risks on that front? So, I embarked on a side journey, testing various crypto exchanges that I use or was curious about. Call it a personal audit. I made accounts on a bunch of well-known exchanges and a couple of lesser-known ones, and I went through their full KYC Know Your Customer process one by one. Yes, I subjected myself to the oh-so-fun ritual of uploading my passport, driver's license, selfies, you name it. Why would I do this to myself? Because I wanted to see firsthand how these platforms handle compliance and security, and ultimately to assess my risk if I'm trusting them with my funds. Ever since the collapse of FTX in 2022, I've been wary of keeping too much on any exchange. That incident was a harsh reminder that even huge, trusted exchanges can suddenly implode, misusing customer funds and leaving billions in losses. Not your keys, not your coins, the old mantra, hit hard when FTX went down. So, as the market started heating up again in 2025, I wanted to be extra sure I wasn't getting complacent. Here's what I found from my little KYC and trade test. Firstly, the big exchanges have really streamlined their verification processes. What used to take days in 2017 now often takes minutes or hours. Some use automated checks, others still manual. But overall, it wasn't too painful. More importantly, going through KYC gave me a chance to poke around each platform's security settings. I made sure to enable two-factor authentication everywhere, a must-do. I also checked what kind of withdrawal protections they have. For example, some exchanges let you whitelist withdrawal addresses, so even if someone hacks you, they can only withdraw to addresses you pre-approved. These little features give clues about how seriously an exchange takes security. I also paid attention to how each exchange communicates about risk. A few of them actually pop up warnings like cryptocurrency is volatile. Only invest what you can afford to lose, which I appreciate. It's better than blasting memes of Lambo and Moon. On the flip side, I won't name names, but one smaller exchange I tried had a pretty lax approach, no KYC for small accounts, and very little in terms of security prompts. That might sound convenient, but it actually scared me off. In the post FTX world, if an exchange isn't at least trying to follow regulations and secure things, I consider that a red flag. Sure, nobody loves KYC, but I understand why it exists: to prevent fraud, money laundering, and to keep the platform stable and in regulators' good graces. An exchange playing fast and loose with those rules might cut and run or get shut down without warning. Another thing I learned was the importance of jurisdiction. Some of the exchanges I tested are US based and regulated, with all the consumer protections that implies however limited they are for crypto, while others are offshore. The offshore ones often offer a wider variety of altcoins or maybe derivatives with high leverage, which can be tempting. But I had to ask, is it worth the risk? If an exchange is in a grey area legally, there's a chance it could be one government action away from freezing withdrawals or locking out users. It's happened before. So part of my journey was deciding which risks I'm comfortable with. For me, I'll use a foreign exchange for a small speculative trade now and then, but I stick to more reputable, regulated ones for any serious funds. Finally, a word on affiliate links. Those links you see where YouTubers, like me, guilty as charged, say use my link and get a bonus. It also helps the channel. I want to be totally transparent. I do have some affiliate links for exchanges I trust, and I tested them myself first as I described. If I ever share one, it's because I personally use or at least believe the exchange is reliable for certain purposes. I'm also careful to disclaim the risks. Even the best exchange isn't 100% safe. If you sign up with my link, yes, I might get a small kickback, usually in the form of a commission or bonus, which helps me continue doing deep dive content. But I'll never encourage you to aping into risky trading just to get a sign-up bonus or something. In fact, the most important advice I can give after doing all this is, don't leave large amounts of crypto on exchanges longer than necessary. Use hardware wallets for hodling. Use exchanges as on.off ramps or for active trading only. That way, even if an exchange goes poof or gets hacked, your core holdings are safe. This approach saved a lot of people when FTX crashed. Those who only kept what they needed on the exchange didn't lose their shirts. In short, this exchange testing escapade might not have been as thrilling as chasing illegal miners or passing Fed speeches, but it was a crucial reality check. It grounded my crypto journey in some practical risk management. After all, what's the point of worrying about macro trends or mining if I get careless and lose my coins to a preventable mishap? So, consider this a friendly nudge. Whatever excitement is happening in crypto, take some time to double-check your own security setup. The boring stuff, strong passwords, secure exchanges, backups of seed phrases, is what keeps those hard-earned sats safe during turbulent times. Okay, Dad, advice over. By now, you might be thinking, we've gone from drones hunting Bitcoin miners to the Federal Reserve to smartphone crypto nodes to exchange safety. Where is this all going? Trust me, I asked myself the same question along this journey. And then it hit me. It's all about power. Literally, electrical power and figuratively financial power. This realization was my aha moment that tied everything together. In Malaysia, miners stole electrical power from the grid to fuel their pursuit of Bitcoin. In Washington, the Fed wields the power of interest rates to fuel or cool down the economy, which in turn fuels or cools down Bitcoin's price. In my own small way, running Unity nodes on 10 phones is harnessing a bit of power from my wall outlet and from my device's processing power to earn crypto. And choosing a trustworthy exchange is about making sure the power over my funds stays in the right hands, preferably my own, as much as possible. Crypto doesn't exist in a vacuum. It's deeply entwined with the real world, maybe more than we like to admit. We often champion crypto as decentralized, trustless, beyond anyone's control. That's true on a technical protocol level, but zoom out and you see a different picture. Crypto is plugged into every human system around it. It runs on the electricity from our grids. It's affected by government policies and global markets. Its value is decided by human psychology, fear, and greed, which are in turn influenced by things like central bank announcements or, heck, even AI news. Did you notice how Bitcoin's mini rally fizzled partly because of some AI concerns? Wild. Realizing this has reframed how I approach crypto. I used to think being a good crypto investor meant just knowing the tech and doing on-chain analysis and reading up on projects. Those things are still important, but they're not the whole story. Now, I pay equal attention to macroeconomics, energy infrastructure, and regulatory moves. I've basically become a more well-rounded researcher, or so I hope. It's like when Neo in The Matrix sees the code underpinning everything. I'm seeing the matrix of crypto, and it's not just code, it's also drones, power lines, interest rates, laws, and yes, even bird noises and old smartphones. The twist in my personal narrative is that by exploring these very different threads, I ended up with a more holistic view of crypto. The illegal mining saga taught me about the physical limits and consequences of this digital revolution. The Fed saga taught me about the economic underpinnings and how interlinked crypto is with the broader financial system. My Unity nodes and exchange tests taught me about the grassroots and personal responsibility side, that we each interact with crypto through devices and platforms that require care and knowledge to use safely. In a way, I discovered that crypto is both revolutionary and yet dependent on the world it seeks to change. And rather than seeing that as a contradiction, I now see it as crypto growing up. These pain points, energy use, regulation, market dependence, are signs of a maturing industry colliding with reality. It's not bad or good per se, it just is. What matters is how we respond to it, how we innovate around it. Ethereum's switch to proof of stake, dramatically cutting power use by approximately 99%, is one positive example, reducing the electricity burden. On the financial side, maybe Bitcoin becoming a mainstream asset means we have to accept it'll behave like one, tied to interest rates and all, until maybe it grows so large that it sets its own agenda. This realization has made me more humble as an investor. I no longer assume any one factor will guarantee success. Number go up because halving, or X coin will moon because partnership. Instead, I ask, what forces are at play here? Are miners going to be incentivized to keep going? What's the Fed doing next quarter? Is some new tech going to change the equation? It's a lot to take in, but I'd rather see the full picture than be blindsided by a piece of it. As I wrap up this journey, I'm left with a mix of awe and cautious optimism. Who would have thought that digging into a Bitcoin electricity heist and Federal Reserve policy in the same breath would yield a life lesson? Yet, here we are. 2025 showed me that crypto, for all its novelty, is deeply connected to age-old elements: crime and greed, governance and innovation, risk and reward. My biggest takeaway is that staying informed is everything.